Good morning, everyone, and welcome back to Retire on Dividends. Today, we're diving into something that's been flooding my inbox lately, our MSTY, the YieldMax Micro Strategy Covered Call ETF. And honestly, after spending the last couple weeks really digging into this thing, I've got some thoughts that might surprise you. So here's the deal. MSTY is advertising a 140% yield. Yeah, you heard that right, 140%. When I first saw that number, I thought it was a typo, but nope, that's what they're actually distributing. And with over $4 billion pouring into this fund since it launched last February, clearly a lot of people are chasing that yield. But here's where my years of making dividend investing mistakes really kicks in. Remember back in episode 4 when I talked about how I was using YieldMax ETFs all wrong? Well, MSTY takes those same issues and cranks them up to 11. And if you're building a retirement portfolio, like we've been discussing, this is exactly the kind of shiny object that can blow up your entire strategy. Let me break down what's actually happening here. MSTY doesn't even own MicroStrategy stock. Instead, they're holding treasury bonds and selling call options on MSTR. Now, I've done the wheel strategy myself, selling puts and calls, and there's nothing inherently wrong with options, but when you're distributing 140% annually and your underlying strategy can't possibly generate that much actual income, well, where do you think that money's coming from? It's coming from your principal. This is what we call NAV erosion, and it's the dirty little secret of these ultra high yield products. They're literally paying you with your own money and calling it a dividend. It's like taking 20 bucks out of your left pocket, putting it in your right pocket, and celebrating that you just made 20 bucks. Now, I know what some of you are thinking, but Jordy, what about the tax advantages of getting return of capital? And well, funny story about that. When MSTY launched, everyone thought most of the distributions would be return of capital, which gets favorable tax treatment. But surprise, when tax season rolled around, 100% of the distributions were classified as ordinary income. That means if you're in a high tax bracket and holding this in a taxable account, you're getting absolutely hammered. Speaking of taxes, let's talk about where this thing actually fits in a portfolio, if anywhere. In episode 2, I talked about the Bogglehead principle of simplicity. MSTY is the opposite of simple. You've got options overlay strategies, single stock concentration risk, Bitcoin exposure through MicroStrategy, and distributions that swing wildly from month to month. One month they paid out $4.13 per share. Another month it was $1.33. How do you plan retirement income around that kind of volatility? And here's what really gets me, Rar. While MSTY investors were collecting their volatile distributions and watching their NAV erode, MSTR stock itself was up 89% over the past year. Bitcoin was up over 100%. So you're taking on all this complexity and tax inefficiency to underperform just buying and holding the assets you're supposedly getting exposure to. Look, I've made my share of yield chasing mistakes. Back in my early investing days, I bought into all sorts of high yield traps, thinking I'd found the secret to easy income. But here's what I've learned after years of trial and error. Sustainable dividend investing is boring. It's supposed to be boring. SCHD might only yield 3 to 4%, but that yield grows over time and doesn't destroy your principal. Now, does MSTY have any place in a portfolio? Maybe, and I mean maybe, as a tiny speculative position in a tax advantaged account. We're talking 1 to 3% max, and only if you fully understand that this is gambling on Bitcoin volatility, not investing for retirement income. But even then, I'd ask yourself, why not just buy Bitcoin directly or MSTR stock if you want the leveraged exposure? The truth is, products like MSTY prey on our desire for easy answers. We see that 140% yield, and our lizard brain goes, wow, I could retire tomorrow. But building real wealth through dividends takes time, patience, and mostly just staying away from things that seem Too good to be true. Remember our core and satellite strategy from episode 5. Your core should be rock solid dividend growers and broad market ETFs. MSTY isn't even satellite material. It's more like space junk that'll eventually burn up on reentry. And when it does, it'll take your capital with it. If you're serious about building a dividend portfolio for early retirement, stick to the fundamentals we've been discussing: quality companies with sustainable dividends, diversified ETFs with reasonable yields, tax efficient strategies that compound wealth over time. That's how you build something that'll actually last through a 30 or 40-year retirement. I know it's not as exciting as a 140% yield, but you know what is exciting? Actually having money left after 20 years of retirement, actually being able to sleep at night knowing your income stream is sustainable, actually building wealth instead of just shuffling it from one pocket to another. So that's my take on MSTY. It's a complex option strategy masquerading as a dividend investment, and it has no place in a serious retirement portfolio. If you want Bitcoin exposure, buy Bitcoin. If you want dividend income, buy dividend stocks. But don't fall for products that promise you can have your cake and eat it too, just because in investing, you usually end up with neither. Thanks for joining me today. Next week, we're going to talk about something a lot more positive: how to build a dividend ladder for consistent monthly income using ETFs that actually preserve your capital. Until then, keep your eyes on the long game and remember, boring dividends are beautiful dividends. This is Jordy, and you've been listening to Retire on Dividends. If this episode saved you from making a costly mistake, hit that subscribe button and share it with someone else who might be tempted by those triple digit yields. See you next week. See you next.